What would happen if a major bank failed? What would the systemic risk look like? There's no telling how bad the situation would be. No central bank has prepared for that level of destruction. They believe in the optimistic scenarios because they are so intelligent, so wise, and yet, in reality, so diabolical. Their actions intentionally create the crisis we face and then can pose as the saviors buying up all the assets for dirt cheap. You came here for the truth, so let me unveil that for you. Today we are going to look at the systemic risk. We're going to take a look at Deutsche Bank. We're going to show you what the Bank of Canada has done. I want to talk about margin debt. I have so many different issues to cover today. Not enough time, so let's begin by taking a look at this. Systemic risk among the GSIBs, global systemically important banks. You're looking at Deutsche Bank in the middle here, surrounded by the biggest banks on earth. Whether we're looking at JP Morgan and Bank of America, or perhaps BNP and Commerce Bank. You have to understand how all of these financial institutions are connected together. They're attached at the hip. When you see the financials of these corporations and how twist-tied they are together, they cannot be removed apart from each other. No one major bank can fail without it affecting the entire world. It doesn't have to be Deutsche Bank. It could be another one of these that you see here. Any one of these fails and you have a major catastrophe. There is no denial here because these banks are so big that they are not only too big to fail, they're too big to bail. This was an article I showed you recently out of Bloomberg, but I didn't cover this portion. And essentially what they're talking about is Deutsche Bank's situation and what they could do. Will they cut more? Yes, they want to cut thousands and thousands of people if they merge with another company, as the second paragraph gets into, where they're talking about potentially getting rid of thousands of workers, talking about how they can make the mergers work beneficially, they can increase productivity, and they can get this business up and running again. That doesn't excuse the debt problem that they have, doesn't excuse all of the scandals and schemes and everything that's happening. All it does is simply fix it on paper so that the stock doesn't die. That's what they're looking at here. They cover a lot of the details, talking about Commerce Bank as one of them, potentially suggesting that, they maybe could merge together and so on. All I do is look at something like this and I have to believe that a company as big as Deutsche Bank simply cannot be allowed to fail. There is just one problem. It's too big to bail. And that's what I always ask my subscribers: by what mechanism will they bail out Deutsche Bank? It's probably going to fail at some point or get close to failure, and they'll need to bail it out. But I don't understand by what mechanism. They simply cannot print enough money to bail it out. By nationalizing it, it would put such a heavy burden on the backs of the taxpayers in Germany, and therefore there's no possible way to allow it to happen. So what exactly could they do this time? Would they do a bail-in, perhaps? Would they split the company up? Would they restructure the debt somehow? I don't know. I don't know how they'll do it, but it doesn't look good. Now we're going to look at the different currencies this year, global foreign exchange rates, currencies against the US dollar year to date, and basically everything has struggled. Some definitely more than others. Argentine peso is the worst performer of the year, almost 50% of its currency evaporated versus the US dollar, the Turkish lira nearly 30% of it. Now that has changed over the course of the year. It was actually much, much worse than that. It has improved a little bit, but take a look at other currencies like the euro, like the Canadian dollar, like the Swiss franc. Even these currencies have seen a depreciation to a lesser extent, definitely, than some of the others, but no doubt they have all been suffering against the US dollar. That affects people at home, that affects imports and exports, that does have a major impact on all of these assets that are being bought up by these different countries, by these different institutions, and that could have a disastrous effect, particularly if some of these institutions start to gamble on these exchanges, start to make bets and plays based on a currency or based on a nation, and then suddenly something happens there, and then you start to have a lot of defaults. Then you have this unwinding of their derivatives, perhaps. We can see anything happening today. There's nothing out of the imagination that is possible. As markets wobble, cash is king. In a year of anemic returns and wild gyrations across most markets, cash is a star. US cash and cash equivalents are on track to be some of the best performing assets in 2018. You could see what has occurred with the different currencies across the world. It's clear that US cash seems to be much more beneficial than putting your money into one of these different emerging markets, perhaps, or any of these other currencies. You want US cash and cash equivalents. And why do you do this? It's because you want to stay liquid. It's because you want to be, quote, safe. And that's why these investors do that. But it didn't happen in the previous years so much as it does this year in 2018, because individual investors are trying to always seek out the maximum profits. But as soon as the risk is there, as soon as the fragility is apparent, you start to lower your risk and you start to spread that around into things like cash. That's what they're doing, and that shows us that the markets don't believe in the safety that we're being told about. Now, Canada's central bank took a break from raising interest rates on December 5th. The pause could last longer than many were expecting, mostly because policymakers are worried that the energy industry's contribution to economic growth will be, quote, materially weaker than expected only a couple months ago. They thought that it was going to be okay, but it was widely accepted that they would never be able to do this. Oil's looking very weak right now. You're seeing what has happened with the housing market slowing down as well. You could see the general economy not doing good. There's always the threat of trade issues with the United States. So of course they left it at 1.75%, and the mortgage rates are still historically unbelievably low. This would give a signal to individuals that don't worry about it, you have more time to buy a house before the mortgage rates increase. And it's unbelievable how much risk people take today. Speaking of risk, margin debt. People don't have the cash, and people don't want to put all of their savings into just one thing. They want to be able to maximize that. So what do? Well, they use the casino known as margin debt. This is margin debt and free cash balances, and you'll see here net credit balances, the red areas, showing us that this is a risk taker's game. And you'll notice over the years more and more margin is being used. Looking at the margin balances here, the blue line, constantly rising higher and higher. And when we do see this, it is at the peak, of course. We saw the risk that people took in the previous crises and the one before, using the maximum amount of margin, and that doesn't end well. Interconnected with that, we have this free cash balances versus the S&P 500. It is no doubt, this is inverted by the way, the net credit balance, the red area. No doubt about it that this is completely and utterly correlated. If you are going to use maximum margin, you're going to see the S&P 500 or the stock market increase. There's no other way to look at that. That's what people are doing. Investors take the maximum risk and then receive the maximum punishment when the margin calls come in. Margin debt growth versus the S&P 500, completely and entirely correlated together. It's as if it's a mirror image, particularly since the financial crisis. All right, now looking at this. Of course, you saw the inversion of the yield curve, but we're still waiting for some, and I wanted to show you these. When the front end of the curve inverts, the 3-month, 10-year curve eventually follows. We can find no historical example of the 2-5-year inverting without the 3-month, 10-year eventually following suit. That shows us where we're headed right now, where we can imagine this will be in a short period of time. I don't know if it's going to be tomorrow, the day after, or what have you, but all of them are going to have to invert, and we are going to have a recession at some point. This is a leading indicator, but it doesn't mean that because two lines cross over each other, that eventually makes the system crash. That's not what we're saying here. It's that it's just telling us, it's foreshadowing the crisis that is upcoming. That's all it is. US market cap as a percentage of the GDP. The risks that people take today are obvious. It happens every single time, and we are currently sitting at 166%. This is often considered to be the whole Warren Buffett indicator and so on. But looking at this, we can tell that it is literally the worst it's been ever. The worst ever. And that should be a warning sign to everybody. But nobody's worried. Nobody is worried because the central banks are there. Except the fact that the central banks are now pulling out support in their quantitative tightening policy. But let's not worry about that because it's too big to fail, so have no fear. Now, this is something about the lending businesses, the cash advance, payday advance, and so on. Contractors, truckers, and other business owners across the country are being bombarded with offers from cash advance companies. These lenders charge interest rates that can exceed 400% annualized, more than some mafia loan sharks once charged. They get around state usury laws by saying cash advances against future business receipts aren't loans. That's the way it works. So this is how they are able to do so. They have unfortunately been putting a lot of people into a really bad situation. There are certain times when I could say, desperate times, desperate measures, no doubt about that. However, a lot of people, they get into a mess. They get in with a little bit, and unfortunately, it just gets worse as time goes on. They are trying to just get a loan of a few $100s. They eventually can't pay that back. And of course, with these very high levels of interest, it's only going to make matters worse as the days go on. Sadly, many people are caught in this trap of debt, and it is our duty to get out of this debt that the bankers have created. By paying off your debt, you literally defund their criminal institutions. So you can do that very easily in your own way, on your own time, and it's all in your hands. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. So I do appreciate that very much. Last but not least, if you want the financial education you were not taught in school, these two books have it all. You can flip through the books at Amazon. There's a link in the description if you're interested in checking that out. If you want the audiobook version, you can get that at themoneygps.com.